Okay, good morning, everybody. So the theme of today's event is how to have your goals chase you. About 7 years ago, I met a guy named Rob Vivian. I think you know him. And I was in his fast start class at that time. I was the only mortgage person in the class, and everybody else was a realtor, and all these people were being told that their goal, that they should probably be considering is trying to get into that top 1% of TREB, which would mean around 50 transactions a year. So I sat there as the mortgage guy and I said, you know what, if it's 50 for those guys, I need to do a few more because we don't make as much per transaction as a mortgage broker. So I set myself the goal of 80. Do you think Rob was okay with my goal of 80? No. He looked at me and he said, your number's 150. And I said, what are you smoking, buddy? That's a lot of deals, right? And I really, at that point in my life, I had never thought that those types of numbers were possible. But what happened, either consciously or subconsciously, is that number got planted in my head. And from that day forward, I started to move towards that goal. And as I started to move towards that goal, doors started to open, phones started to ring, and deals started to close. And I'm happy to say that a couple of years ago, I sent Rob a Christmas card. And in that Christmas card, I gave him also a gift voucher, a gift card, to his favorite store, which is Bass Pro Shop. If you want to buy anything for Rob, Bass Pro Shop is what you buy for Rob. And that gift card was for the dollar value of $169. And that's a weird number. Why would I give him $169? It's because that year was the first year that I'd broken his number, and I'd hit 169 deals that year. Okay? Thank you. That came about because I was moving towards my goal, and at the same time, my goal was moving towards me. Every step you take towards your goal, every action you take, is going to push you in that direction. So what happened is now, again, once I heard that number 150, the goal was to be equivalent to the top 1% of TREB, and I'm happy to say that I'm actually there. For the last couple of years, my gross commission 5 years ago was a very respectable $178,000. And for the last 3 years in a row, it's been over $600,000. And it's because I've implemented into my business some of the information I'm about to share with you right now. What I'm about to share with you is a different approach to your database. Some of you may have seen me present this, maybe at TREB, maybe at Oreo. But it's a different approach to your database that will effectively create extra deals for you. How many extra deals? Well, I think that if any one of you chooses to apply this information into your business today, that this year and every year you're a realtor, we're likely going to be able to create an extra 5 deals a year. If you're going to be in this business 10 years, what I'm about to share with you will create for you 50 extra deals and $500,000 in extra commission. Okay? So please listen, because I know each and every one of you are able to apply this to your business. And in fact, a lot of you in the room have already helped apply this in your business. So I'm here to talk about this idea of deal creation. All of us in the room have a number this year. Hopefully by now, you've worked out how much money you want to make for this year. You've broken that down into the number of transactions that you want to do this year, and you have your number. Let's just say that your number is 30. Okay? We're going to make your number 35. You get your 30, here's how we get an additional 5. Okay, and we do it by talking to your database in a slightly different way. And by the way, this couples directly with what you're already doing with your current training with Rob and your current database calling. But here's what I see. Well, let me ask you this question. The answer's on the board, actually. If you have 100 homeowners in your database, and all of you have at least 100, but if you have 100 homeowners in your database, in the next year, how many of them are actually going to be buying or selling? Probably around 10. 10 or less, in fact. Okay? And so if you're good at what you're doing and you're staying on top of them and you're calling and engaging, then hopefully that means you will get 10 sales and a subsequent 10 purchases. And there's 20 transactions ready for you okay, as long as you're there when your client needs you. And that's great, but, and while I do make a big chunk of my money and my yearly commission from there, the majority of the money that I make is actually from talking to the 90%. So what do I mean by that? That 90% are the people in your database who like you and trust you and would use you if they needed a real estate transaction. But as of today, they're very happy in their family home. Their kids go to school around the corner. They've got a great commute to work, and they are not moving for the next 5 or 10 or 20 years. Can you all relate to who I'm talking about? You can probably visualize these people right now in your database. Okay. So these people, right now, they don't need you. But they do. And the way that we start to engage these people is to explain to them, hey, while you personally right now don't have the need to move, you have the ability today, which you didn't have 5 years ago or 10 years ago, to actually go out and purchase more property, purchase investment property. Okay? And we show them how that investment property purchase can go off and answer what I call the 3 big financial questions that keep Canadians up at night. And those questions are, how do I pay off my home in 10 years? How do I pay for my kids' education in full? And how do I build wealth for retirement? These are the 3 things that all of your clients are constantly thinking about, that probably all of you should be thinking about at some point. And we can position real estate as a solution to these problems. Every day, guys, you wake up and you choose to solve problems. The problem for your client is they need shelter for their family. And that's an admirable and noble job that you do. But if in addition to that, you can show that you can provide them with other solutions, then obviously you're going to be a much more important part of that client's long-term goals. Okay. A little bit about me. So I work with a company called Butler Mortgage. About 5 years ago, this was our total funding volume, $400 million that year. Last year, we broke over $860 million in funding. Some of that has to do with the fact that prices went up, okay? Houses cost more. But most of it has to do with the fact that we work with clients who have equity, and we put them on a plan in order to buy multiple properties over the course of a period of time. And along the way, we help all of our realtor partners create an extra $1 to $1.5 million in transaction over a 1 to 5 year period. We talked about that already. So today we're going to talk about the investment options for you and your clients, and why real estate may be better than the alternatives, and how this knowledge can help you, help your clients and help you grow your business. As you're listening today, I want you to listen with 2 ears. One is how you as a realtor can take this and help yourself grow your business. And the other is you as an individual who runs your family, and how you can use this information to boost your financial future. This is what I know investment property can do. And these are the 3 big points that I have built my career on. How to pay off your home in 10 years, how to put their kids through university, and how to build extra wealth for retirement. Okay. While these are the 3 big questions that I've been answering for the last 10, 15 years, there's been 2 other big ones that have come up in the last 3 years. And they are, how will my kids ever buy a house? And for my older clients, how will I afford to care for my elderly parents? These are the big problems that all of your clients have faced or will face in the future. And if you can be there to help them solve these problems, you're going to be an integral part of their life. What's important to know about investment in general is how banks lend money. Okay? As an investor, do you think it would be good to know how the banks invest their money? Of course it would be. So let's take a look. In Australia, I was a financial planner. I was actually also a real estate agent. So just know that I've been on your side of the fence. And in Australia, when I was working at the financial planning firm, I was at a smaller boutique firm which gave not just advice in the traditional financial planning, but also on the acquisition of businesses and property. And so I want you to imagine that you walk into your bank tomorrow with $100,000 to invest, okay? And you sit down with the bank manager and you say, hey, Mr. Bank Manager, here's my $100,000. I'd like to go off and buy a business. Has anybody here tried to do this? Gone to a bank for a business loan? Okay. Was that a fun experience? Yeah, okay. If you go into your bank with $100,000 and you ask your bank manager for a business loan, the chances of you getting that loan are very slim to nil, okay? And the reason is that $100,000, the reality is you're not buying a significant business. If you walked in there with $1 million, that would be a different conversation, for sure, because you'd be buying a significant business. But you and most of your clients don't have $1 million cash lying around. And so at $100,000, I would say best case, your bank might be willing to lend you $100,000, which would mean that you could go off and buy a $200,000 business. Now let me ask you this. At that point, do you think you've bought a business where you can hand the keys over to a 20-year-old and say, okay, I'm going to be back in a month, run this thing for me? Or do you think you might have just bought yourself a job? And I don't think it'd be a 9 to 5. It'd be a 9 to 9 plus weekends. And at that point, you may as well just become a real estate agent, right? So while it's an option, it is not an option that most of my clients chose, okay? Because they already have jobs. And that's a good thing, because they can qualify for mortgages then. So let's say, okay, we thank the bank manager for that option, and now we look at the option of shares. So, okay, Mr. Bank Manager, go and get your #1 financial planner and bring her in the room. I'm going to give her $100,000. How much will your bank lend me to invest with her? Anybody try to do this?
5 times.
Okay, 5 times? Well, that's significant. I would say that if that's the answer that you got, that person must have significant net worth and must have a lot of assets behind them. But I will tell you that for the regular person off the street who goes to their bank to try and get a loan to invest in shares or mutual funds, the answer is a big fat zero. Okay? But again, let's assume that they're generous on this particular day and they're willing to lend you $100,000. This would mean then that you can go and start a $200,000 share portfolio or managed fund portfolio. So there are 2 first options, and they're great. But now let's look at property. As long as I qualify, Mr. Bank Manager, how much will you lend me to purchase an investment property? I don't know what it is. It could be a house, a condominium, a townhouse. I don't know where it is. It might be downtown, it might be out of town, it might be in a different province. But as long as I qualify, how much, Mr. Bank Manager, will you lend me to invest in this property? And I hope by now we all know the answer is $400,000 at a 20% down payment. Which means that you or your client can go off and purchase a $500,000 asset. So at this point, I want you to ask yourself, what does it mean, or what does it mean in terms of how banks rate risk in regards to shares and property? Which of these asset classes does the bank deem, let's say between shares and property, which of these asset classes does the bank deem as the riskier asset class? Shares. By a factor of how much is it riskier? 4 times. So I'm not saying this. The bank's numbers are saying this. Property is 4 times safer than shares, and shares are 4 times riskier than property. And they tell me this by the fact that they're willing to lend me money on the property, but not on the shares. Does that all make sense? Now at this point, when I present this information to your clients, I kind of want to get them angry. Because their whole life, the bank's been telling them, hey, you're richer than you think. Come on in here, give us your money, and we're going to go put it over here. And every year, regardless of performance, we're going to charge you a management fee of 1 or 2 or 3%. Doesn't matter if it goes up or down, we're going to still take out 3%. Guys, this is what your clients are doing with their money right now. This is what the vast majority of your clients are doing with their money right now. They're putting it over here, directly or indirectly, be it through mutual funds, direct stock, or maybe through the RESPs, RRSPs, or TFSAs. This is where your clients are putting their money. But the bank, they wouldn't put their money there, they put it over here. So, okay, that's all good, we're angry at the banks now. But let's put this into a context that is meaningful to our lives and our clients' lives. So let's say our goal was to make $100,000 over a 5-year period. Well, if we wanted to do that with this business at $200,000, it would mean that we would need, in order to make 100 grand, we would need a 50% return on that business over that 5-year period. With the stock market, it's the same, 50%. I'll put that another way, guys. That's in the stock market, that's you investing in the stock market, getting 10%, 10%, 10%, 10%, 10%. Okay. Now, how many of us have got that? Some of you might have, but I can tell you that the vast majority have not, and very few of your clients have not. Okay, so let's put this in regards to property now. $100,000 on that $500,000 asset. What kind of an increase do we need? 20% return. I'll put that another way, 4%. Anybody in the room got 4% return on their property investment? Meaning that a property that you purchased for $500,000 is worth $520 a year later? Have you experienced this? Have your clients experienced this? We're talking about something that's achievable, that your clients have actually experienced. It's not that hard of a sell. Okay, so that's all cool, but who would like a 25% return on your investment annually? Hands up. If you don't put your hand up, you must leave. The door's there. Okay, okay. So here's how this works. And by the way, you've all got this. Any one of you who owns a property have got this already, and you may not even know it. Here's how this works. You purchase a property, it could be the home you live in or an investment property, for $500,000. Okay? Guys, how much money, how much down payment out of your pocket do you need to put down for this? $100,000. Okay? 20%, I'll touch on this point. 20% down rental purchase deals still exist. Every day I get asked by real estate agents or clients, hey, I thought it was 25%, I thought it was 35%. And that's because they've spoken to somebody at their bank branch who has told them that that's what they need. I'll put it simply. I have clients who work at these banks, who come to me for their mortgages, and I get them their mortgages from the bank they work at 20% down. Okay. So you invest 20% down, $100,000, and then, because the bank's going to go and lend you a mortgage of $400,000. Everybody gets that, right? So now let's say that this property increases in value by 5%. Now I can't guarantee returns, but I've chosen this number because this is the 50-year GTA number. 5% average price appreciation on an annual basis. There'll be ups and there'll be downs. But we've got to choose a number, so that's the number, 5%. So that means the property you paid $500,000 for is now worth $525,000. You're up $25,000, right? Okay, remind me guys, how much of your money did you put into this deal? $100,000. So you have a 25% return on your $100,000 investment. Okay. Now, as I said to you, you've all experienced this. Any one of you who owns a property has probably gotten returns much greater than this on your initial investment. But our job as professionals in this industry is to explain to our clients what's available and what is possible in real estate, and these numbers are realistic. The way to do this, well, you know, a couple of things to talk about here. $25,000 used to be a lot of money. 5 years ago, people were really happy to make 25 grand in real estate. But in recent years, you and your clients have gotten spoilt. Oh yeah, I'll just buy a house and it'll be worth $100,000 more in a year, right? That's actually been the case in recent history, okay? I'm here to tell you that is not something that you can bank on, okay? And we have to remind our clients that $25,000 is still a lot of money. The way I like to position that is, sir, how many extra hours of overtime would you have to work to make $25,000? How many extra months of work would you have to work to make $25,000? And by the way, this is tax sheltered. You don't have to pay tax on this until you sell the property, which may be many, many years from now. Right? And the other thing we want to ask our client is, okay, if they're still kind of foo-foo about this $25,000 because they thought it would be a lot more in real estate, because what they do is all they see is this. They see this 500 and this 525, and they go, well, that's not a really big return. They forget that they only put in 100 grand. Your job is to remind them that they only put in 100 grand. And the way to also position that is, okay, Mr. Client, if you had not invested this money into this property, where would that money have otherwise been for the last 12 months? Where? What's the answer to that question? In the bank, in a GIC making 0.1%, right? Maybe in the stock market, in which case you'd likely have to get a 25% return, a gain in your stock portfolio. Okay, so it's important, and this is very important, and I really want to hit this point home. Property investment doesn't have to be the absolute best investment ever for your client. It simply has to be better than what they're currently doing with their money. I really want you to understand that. You don't have to find the #1 best investment in all of Canada. It simply must be better than what they're currently doing with their money. That is all. And usually we can do that by a factor of 3 or 4 or 5 times. You're also going to get client objections, because when we talk about property, they go, oh, you know what, we don't do that. We hand our money over to other people and have them manage it. That'll be a fairly big objection. And the things that really are at the core of that are, #1, they say that, I don't want to be a landlord, or, what if the tenants don't pay or they damage the property? And, this one here is a big one. I don't want to fix toilets in the middle of the night. So I stand here in Canada. I own property in Canada. I own property in Florida. I own property in Australia. How is this possible? It's possible because I have property management and I have insurance. All of the problems that I've ever heard about with property investment ownership come down to one thing, and one thing alone, and that is the owner being cheap. Right? If you are not willing to engage a professional to fix problems that you can't fix, if you're not willing to jump on things in a timely manner, then yes, your investments will fail. So you have to get management in place. I would make that a non-negotiable. See, here's the thing. These same clients that we're talking to have $200,000 invested in RSPs or some kind of managed fund where they're paying somebody maybe 2% a year to manage it. So they're paying $4,000 a year already in management expense. Are you with me? Okay. If they buy a property and they put a tenant in place, if they engage a property manager, that property manager will probably take somewhere between 7 and 10% of their annual gross income. Let's call that $3,000. Okay. So it's a little bit less, but let's say it's on par with what they would be paying to their manager at their financial institution. The thing is, a property manager only gets paid when they're doing their damn job. I'm happy to pay my property manager. Insurance. If you're going to get into this type of thing, here's a question you want to ask your insurance company. This is the question I ask my insurance company. If my tenant turned on all the taps in my house, lit the roof on fire, and left, am I covered? Yes, I'm covered for the renovation, and I'm covered for the loss of rent for the 12 months that it takes to rebuild that property. Those types of insurance policies exist, and yes, you must get them. So all of these objections can be mitigated and managed. Oh yeah, now the other thing that comes up is cash flow. If I've got to pay a property manager, then that's going to impact my cash flow. Well, yeah, the answer is yes, it will. But here's the thing. People don't get rich in real estate from the $50 a month in cash flow. They get rich in real estate from this, the compound effect. Here's how it works. I've used a very small number here, $350,000 purchase. If we purchase property for $350,000, it increases in value by 5%. It means that it's increased by $17,500 in 1 year. And at the end of the year, it's worth $367,500. In year number 2, we start with this number, right? We carry that number down. 5% growth, we get a higher number because of the compound effect. And if we follow this through for 5 years, then the property we bought for $350,000 is now worth $446,000. The difference between what we paid and what it's worth is $96,000. And for that 5-year period, you've been collecting rent and you've been paying down your mortgage, in this case, probably by about $36,000. Oh, by the way, I see a lot of phones. I'm going to make all of this available to all of you. You just need to email me, okay? But you can take, I'll close. Make me look tall. I need that help. Okay. But here's the thing. When you combine these two numbers, 96 and 36, we've got a number here of 132,000. Okay, so 132,000 is the potential impact, positive impact on your net worth for having owned one property over a 5-year period. Okay. Now, let's talk about cash flow. 10 years ago, you could walk out into the outer areas of the GTA, buy any property, and from day one, it'd cash flow about $500 a month. Can you do that today? No, not a hope. Okay? What we're finding is people are having to probably purchase what we call multi-unit, 2-family dwellings, duplex type situations, where at that point we're kind of breaking even. But I want to give you an example of negative cash flow. Okay? So negative cash flow. Let's assume that this property cost $500 a month in negative cash flow. Firstly, I would tell you don't buy that property. But let's just go with this example as an extreme example. First, let me tell you this. $500 a month, your clients, in many cases, are currently paying $500 a month into their RESPs, RRSPs, and mutual funds and other things anyways. Okay? So it's nothing different to what they're doing. But let's say they had to put it here instead. Well, what would happen is $500 a month is $6,000 a year, and over this 5-year period, that'd be $30,000, right? $30,000? So if it's $30,000, what that means is this number here, instead of it being $132,000, it'd only be $102,000. Would you still be okay? Of course you'd be okay. The other interesting question is, if that $500 wasn't invested here, that $30,000 over that 5 years was directed to the other types of things, what would that $30,000 be worth? And the answer there is about $35,000. And even if it's an RESP or TFSA, it's tax sheltered, or there's some kind of tax benefit, this still beats it after tax. You with me? Yeah. So if this number is true after 5 years, then this is the same property held for 10 years, 20 years, and 30 years. Okay, and I know this number looks ridiculous, but this is just a projection of history. Now remember, this was a small property for $350,000. We paid a down payment of only $70,000. So what this means is, if we sold this property in 5 years, we would get back $70,000 and $132,000. This represents a 190% return on your investment. Annualized, it's 38%. Remember earlier we talked about a 25% return on investment? That did not factor in compound. This does. And of course, the longer you hold it, the greater the return. This is the 10-year number, 43%, 55%, 72%. Do you think any of your clients, financial advisors, are talking to them about an annual return of 72% every year for the next 30 years? And sure, I can't guarantee these numbers. Okay? The other extreme is zero growth. Who here in the room thinks that their clients would think that property prices will not increase by $1 in the next 30 years? Okay. So if 5% is extreme and 0 is also extreme, then maybe a middle number is about right. And so halve these numbers and halve these returns. Will they still be okay with a 36% annualized return? You betcha. Okay? When I talk to my clients, I talk to them about this, the 15-year, $2 million plan. $1 million used to be a lot of money. Do you think you can comfortably retire in the GTA on $1 million now? No, not a chance. So we stopped talking about $1 million a long time ago. We talk about $2 million now. A lot of our clients come to us with a 15-year runway. If they're 50 and they're going to retire at 65, we've got 15 years to help them. Here's how that looks. At a 5% growth, prices double every 15 years. Okay, there's an investment rule, you might want to write it down, it's called the Rule of 72. Go and Google it later on. And the Rule of 72 explains that at a certain percentage rate, this is how long it will take for your investment to double in value. At 5% growth, that investment doubles in value in 14.4 years. So let's call it 15 years. So this is what that means. If we buy a property today for $500,000, well, actually, yeah, this is a quick example. We could buy a property today for $500,000, and it'd be financed at $500,000 because we would borrow. Usually, we borrow the down payment from a line of credit on the principal residence, and then we would borrow the mortgage secured against the property they buy. So on day one, we've got an asset worth $500 and a debt of $500. But here's what happens over 15 years. In 15 years, that property statistically should be worth $1 million. And I know what you're thinking, well, that's a pretty big projection. Here's another question for you. This property that today is worth $500,000, 15 years ago, what was it worth? $250 or less, right? So again, it's just a projection of history. So what happens over 15 years is, if this asset increases by double, and we get our debt paid down, because we're paying down our mortgage, then your client's net worth on ownership of one property will be up by $700,000. And what if we did this 3 times? A lot of our clients come to us with equity in their home. They've got a home worth $800,000 and a mortgage of $200,000. Each and every one of you have people in your database with that exact profile, or very similar. Those people can do this. And if they do this, this is what happens. This is the 15-year, $2 million plan. Everybody with me? And by the way, realtors in the room, this should be your retirement plan too. Because last I checked, you don't have an RRSP, right? Okay, so this is all good, but what do we do with this information? Well, we've got to get it out to our clients. How do we do it? The best way is by just interacting with your database. Who here loves calling their database? Okay, we got some. That's great. Okay. Who here, and I'd really like you to be honest, who here sometimes really doesn't like calling, don't like calling your database? There's a bunch of you, that's fine. There's a bunch of people in the middle, which means you're kind of indifferent, and that's okay too. You all know that calling your database is important. How else are you going to get those 10%, those 10 transactions that we talked about earlier, right? But I understand that calling your database, saying the same thing every 3 months can get a little bit tiring for you and them. So imagine the next time you called your database, you didn't ask them for anything. You gave them something, okay? And let's say the next time you called your client, you asked this question. Hey, would you like to learn how some clients are paying off their home in 10 years? Or would you like to learn how some clients are putting their kids through university or building extra wealth for retirement? If the next time you called your client and asked them one of these questions, I would dare say that would be the start of a conversation that you've never had with them. And it would be the start of you being repositioned in their mind as a transactional mercenary, in and out for the job, and into somebody who actually cares for their long-term future. Okay. And I have scripts along these lines that explain this in more detail. Okay. I'm going to quickly explain how we answer these questions. Pay off your mortgage in 10 years. I want you to imagine that today your clients have that mortgage of $200,000, and in 10 years from now, if they just keep doing what they're doing, it's going to get paid down to about $130,000. That's the numbers. So 130 is where they're going to be 10 years from now. If today they exercise their ability to go off and buy one more property, and 10 years from today they sold that property, that would be the gross proceeds of the sale. They would pay some selling commission and they'll pay some capital gains tax, but they will still clear $200,000 on that sale. Could they take that money and pay off the $130,000 mortgage on their family home? Yes, they could. I'm a mortgage broker. The number one question I get all the time is, what's the interest rate? What's the lowest interest rate you can get me? And what people are really asking me is, how do I pay those bastards at the bank the least amount of money possible? Right? And my answer has and will always be the same. You've got to pay it off early. 2 ways to do that. Number one, the way we all know, double up on your payments, put in your lump sums, forego lifestyle. Don't go on vacations, don't go to restaurants and put your kids in crappy schools, and pay off your mortgage. That's option one. Option two, create something else that can be liquidated at a future point to pay off the home that you reside in. Okay, I chose the second option. Pay for your kids' education. Here's how RESPs work. You can contribute $200 a month into your children's education savings plan. Over 20 years, it's $48,000. And the government matches you to about $7 grand. You've got 55 grand invested. And at the end of 20 years, you'll have about 100 grand to give to your child. And that's great. You could give your child $100,000, or you could give them $770,000. My kids don't have RESPs. My kids have homes. And by the way, this also answers that other question, that unwritten question, how are my kids ever going to buy a property? Well, this should surely be enough to get them a good education and represent a good, healthy down payment on a home that they want to live in. We get 2 birds with 1 stone here. And build wealth for retirement. Well, if you're under the age of 30, just buy one house, wait 30 years and you'll be a millionaire. Congratulations. But very few of us are, and most of my clients aren't, under the age of 30. So what happens is, they're somewhere in this range, and they'll go out and they'll buy 2 or 3 properties in very quick succession so that they can go and hit this $1 million or $2 million number at the time of retirement. The way we get this information out to your clients, guys, is through seminars. I've been doing this now for over 5 years. I've done it for many people in the room here, and we have very good conversion rates. We create deals from your existing database. I have a full marketing plan that explains to you how you can approach your database, how to logistically go and set up the room. Everything is done paint by numbers. I have written the emails for you that you can copy and paste and send to your clients to invite them to this event. I've done everything for you, but I cannot call your clients and I cannot email your clients. That will be up to you. But if this is something, can I just get a show of hands? Who thinks that this is something they want to do in their business? Okay. I've got it all for you. Come and see me at the back corner there and we can talk about it more. But at that seminar, we educate and then we convert them into action. We convert them into deals. Okay? And if you're willing to work with me, I know we can create that extra 5 deals for you this year and every year of your real estate career. Okay, well, that all came up at once. Summary. Today we've talked about deal creation. There is gold in your database, in that ignored 90%. Stop ignoring them. Start talking to them. We talked about shares, business, and property, and why property is what the banks bank on. We can teach our clients now how to pay off their home, pay for their kids' education, and build wealth for retirement. We can hold these events and elevate you in the eyes of your client. I have the scripts and full marketing material. If there are team leaders in the room, broker owners, come and see me and we can talk about hosting an event for all of your team. And if you're an individual agent who just wants to make this happen, again, come and talk with me and we can make that happen. Okay, guys, that brings me to the end today. Thank you for your time. Please contact me.